Hello everyone, welcome to today's video. As someone who pays income taxes in both India and the UK, I was keenly following the UK autumn budget which was presented on 30th of October last week. In this video, I will try to break down the salient features from the autumn budget in UK which are relevant for NRIs living in the UK and try to explain how it affects our personal finances. I will mainly focus on the budget rules that applies to salaried people in the UK, people who don't employ other people in their businesses, and is in the phase of life where we are mainly focused on growing our wealth rather than thinking about passing down our wealth to our next generations. This actually defines the majority of the audience of my YouTube channel, and my YouTube analytics tell me that more than 86% of my current audience are aged between 20 to 54 years. Also, being an NRI, my parents are in India, so the inheritance rule in the UK does not directly apply to me. So I have decided to skip those rules of the budget in this video. The first important change that I would like to discuss in this video is about the capital gains tax rate. Basic rate taxpayers in the UK will now be paying 18% capital gains tax, up from 10% previously, on gains made when they sell shares outside of an ISA or pension account, any second property or any other asset sales. This rate has gone up to 24% from 20% for higher rate taxpayers. Now, what can you do to avoid this capital gains tax legally? The first thing to do is to use up your ISA allowance. If you don't remember, the ISA allowance is £20,000 per person per year. You get £20,000. Your husband or wife will get another £20,000. If you have children, then each of the children will get £9,000 in their junior ISA allowance. So for a couple with 2 children, you can save up to £58,000 per year tax free. If you were lucky enough to have more savings than £58,000, then you can use your SIP or SIPP, which is a pensions account, and the total limit being £60,000 per year. This also includes your employer contribution, so be mindful of that. If you have more savings than this, then you can still invest in a general investment account. Here you will have an capital gains tax allowance of £3,000 for this tax year. So you could still sell some of your investment and make a profit up to £3,000 tax free. Now, if you do this before 5th April 2025, then on 6th April 2025, when a new tax year begins, you could sell more of your shares and make another profit up to £3,000. Then you don't have to pay any capital gains tax on this profit. Now, let's say you are wealthy enough to use up all of these options and you still have some savings left. In that case, another option is to consider the EIS, or the Enterprise Investment Scheme, which is a UK government initiative designed to help small, high-risk companies, which are usually startups, to raise finance by offering tax relief to investors. Investors can claim up to 30% income tax relief on their investment in EIS qualifying companies. This means if you invest £10,000, you can reduce your income tax bill by another £3,000. Now, if you use up all of this scheme and you still have some money left, then you should start your own YouTube channel and try to teach us how to make so much money. If you are enjoying this video till now, then please hit the like button, This will let the YouTube algorithm realize that this video is an useful video, and it will help this video reach out to more and more people like you. If you are new to my channel, hello, my name is Suman. I am a doctor working in the UK, and on this YouTube channel, I share my experience of managing my own money and investment both in India and in the UK. If you are someone who is trying to grow your wealth and working towards financial freedom, then please consider subscribing to this channel and be a part of this growing community. As a disclaimer, I am not a financial advisor and I can't tell you what you should do with your money. And this video is for educational purposes only. Here I would like to mention briefly about another important change about pension being included in the inheritance tax. This means the unused pension when you die will fall under inheritance tax. I don't want to go into too much detail about this in this video because by the time I retire and start getting pension, there will be approximately another 30 budgets in the meantime. So the rules will definitely change. So there is no point worrying too much about the rules at this stage of my life. This brings me to the second point, that is buying property. Bad news for the housing market and property investors. The stamp duty holiday for first-time buyers was not extended. So this will end in March 2025. And the stamp duty surcharge on second homes will increase from 3% to 5%. This will affect people who are planning on buying second house as an investment. For all home movers, this means the basic threshold at which you pay 2% tax will be reduced to 125,000 from the current level of 250,000 pounds. However, first-time buyers will see their threshold fall from 425,000 pounds to 300,000 pounds for the stamp duty allowance. The third point that I would like to discuss here is freezing of income tax thresholds till 2028. Income tax thresholds will not be frozen after 2028, so the relentless increase in tax we all pay should ease from 2028. Now you might be wondering that if the tax rates are not changing, then is that good or a bad thing? It's actually a bad thing for salaried individual like us, because every year our salary is going up slightly, and if the tax thresholds are not rising accordingly, then we are actually paying more and more taxes even without the government actually increasing the taxes. This is called fiscal drag. Rachel Reeves, the Chancellor, said that this might be reconsidered after 2028, but again, there is no guarantee that this is going to happen. The next rule change from this budget, which might affect some high net worth individual, is abolition of non-dom status. The term non-dom refers to individuals who are resident in the UK but whose permanent home or domicile for tax purposes is outside the UK. Non-doms only pay tax on UK income but not on foreign income unless they bring the money in the UK. The Labour government has announced that the abolition of non-dom tax status from April 2025. This means that non-doms will no longer benefit from the preferential tax rules in the UK. These are some of the important features of Autumn Budget 2024 that might affect our finances as NRIs in the UK. Let me know your thoughts on this tax rule changes and how you are modifying your investment strategy in light of these rules. If you are still thinking about starting your first investment within an ISA account and not sure how to start, then please watch this video next. Thank you for watching. See you next time.